All right, so we're looking at some of the action in the pre-market. We were just showing Alphabet higher, NVIDIA lower, almost kind of inverse moves for the two of those. This change in AI leadership, are there deeper ramifications? I was asking somebody yesterday, do investors have to shift their portfolio? Are there moves that had to be made if NVIDIA isn't the same stock it's been over the last few years?
Well, I think there are two important takeaways. One is that you want to keep exposure to that broad bunch because leadership changes from week to week based on who's perceived to be in the lead. And the second is I do think it indicates a little bit of a shift from the first phase of the AI wave, which is sort of the build out and the chips and the picks and shovels, into the utilization phase. And so we're pretty excited about that shift because we think it has some good implications for earnings down the road.
All right. BofA came out with a note yesterday looking at tech stocks and their outflows. So tech stocks overall have had outflows for 6 consecutive weeks. Last 4-week rolling average, the lowest, the lowest for tech stocks since June of 21. Basically, not great for tech stocks. Let me just sum it up. Not doing a great job reading that one part. At the same time, we're seeing Alphabet move higher. So it looks like people are trying to pick the winners and they're getting a little bit choosier. When we're looking at that, what areas of the tech trade do you see as being perhaps vulnerable to this idea of a choosier investor? Is it perhaps energy names? Is it other chip names? Because remember, chips are cyclical.
Yeah, I think the chip names are a little bit of an area of focus here in terms of valuation and speed of execution. There's a lot of great news baked into these stocks, and the question is, will it all come in on plan and on schedule? If it slows down a little bit, those returns come down, as you know. So that's one of the reasons I think we're seeing a little bit of the heat come off of those, a little bit of valuation decline, and some broadening out in markets.
All right. When we're looking at that, and we're also looking at some of the other things, another announcement about job cuts, weakness in the labor market from that ADP report. Are you starting to get concerned about the broader economy? Even though we're not seeing actual numbers and data showing that, but we are going to get a jobs report coming up next month that people expect to be a bit weaker. Is that starting to be a concern? And what parts of the market do you see that possibly impacting as we round out this year?
Yeah, it's a really important question. We've been describing the economy as growing but slowing, and we're not quite yet below stall speed. For us, stall speed's below 1.5%. That tends to be a big problem for earnings growth. We're not there yet, but there are some question marks. And so it really calls into question how quickly will the Fed move, how quickly will they cut rates and throw a little more fuel on the economy, because it seems to need it here. It's decelerating a bit.
All right. So if it's decelerating a bit, is this the time to maybe move into bonds? I mean, we've seen some reports out here, bonds having a great year this year or a great quarter. I mean, you see these reports about bonds. Are the yields attractive right here, and are they creating any competition for the equity market, not only due to the possibility of getting some income, but also just some stability because of the volatility?
I do. I think bonds are pretty compelling here. We moved to more of a neutral posture about a week ago on the basis of, look, the longer term is going to be really solid. We think there's a lot of earnings gains to come over the next few years. But tactically, you have these high valuations. You're sort of set up to, you have to deliver to perfection on the earnings side and on the equity side. And so bonds do still look compelling here with yields around 4%. That's not a bad place to move a little bit of capital, be a little bit more neutral in the short term.
All right, so then what? I mean, we got a whole month left to the year. It feels like we've had every twist and turn over the last couple weeks that you could have. And there's also the specter of a couple things coming up next year. What's the Fed going to do? A decision on tariffs. There's just other things coming up, and maybe even more weakness in the labor market due to AI or just other factors. So if you're an investor, what do you do? How do you see the rest of this year?
I think the most exciting area of potential is to see some broadening out in the market. We're seeing a little bit of it this month in terms of a rotation, and you could see that heading into next year as well. So areas like healthcare and small cap look particularly interesting. They've both shown some strength. They both have the potential to gain in the years ahead. So it's not a situation where the top of the market is necessarily struggling, but it's struggling to necessarily perhaps meet expectations and deliver above and beyond those. And so the areas of opportunity are really, let's see if we can get some broadening out here. That would be very healthy for equities over the long haul.